Hello and welcome to the inaugural ITPM Flash. My name's Edward Shek and I'm reporting in from Phuket, and we're about to complete the ITPM 2023 Thailand mentoring program. Now, I'd like to talk about financial repression that still exists in the market set up today, and more importantly, how I'm going to use this to help manage my net bias in my long-short equity options portfolio. So what is financial repression? Financial repression is just the term used to describe a negative real interest rate environment. And when we're thinking about real rates, we're not talking about the Fed funds rate, of course. We're looking at nominal interest rates, and these refer to the interest rates that are quoted by financial institutions, lenders, and of course that will include a spread off the yield curve. So when we look at the level of repression, we're going to be using the 10-year yield, and we're going to use the CPI as our inflation metric. So what does it really mean? Well, it means in this environment, the purchasing power of your savings decreases over time. So if you've got $10,000 or $1 million in the bank, you're literally losing money every second that I speak. And the implication is that at some point you may be forced back into risk assets. At the institutional level, decision making is potentially directed further up the risk curve, as holding an overweight cash position is also losing performance in a flat or rising equity market. Now, we all understand the consequences of QE over the last 15 years. Generational low rates led to funds flowing into risk assets as all participants moved up the risk curve. So if you're a fixed income investor, that may lead you moving out of an overweight sovereign position to underweight, moving all the way through the corporate structure from AAA, triple B, and all the way up to junk as you're chasing yield. And obviously in risk assets outside of fixed income, that led obviously to a lot of funds flowing into equities, private equity, venture capital, real estate, crypto, collectibles, and all the rest. So at an institutional asset allocation level, that meant underweighting fixed income and overweighting equities. So this is well known. The secondary effects of QE led to a huge rally in risk assets up until the point the Fed lost the word transitory and we've had the interest rate cycle. Now, I think it's very easy to associate financial repression with zero rates. So it's easy to think that financial repression has ended as rates have rallied and we are at or close to terminal rates at the end of the tightening cycle. And therefore, it's easy to think that there is an investment alternative to risk assets. In other words, easy to think that the TINA trade has unwound and that this is going to be an ongoing headwind for equities and other risk assets. After all, today, you can move your cash into a money market fund, maybe get a 4-handle, 4% or more, and that certainly doesn't seem like financial repression in the context of the last 3 years, but you're still getting a negative real yield. So anyway, let's have a look at the chart of financial repression. You can see the red areas highlight repression. And interestingly, there wasn't a great deal of financial repression from the great financial crisis to the pre-COVID era, at the end of the pre-COVID era. And that might surprise when you think how low rates were, and in light of how risk assets were starting to perform. So we had 1 year of financial repression during the GFC chaos, and one 18-month period from 2011-2012. Now, the reason for this lack of financial repression was that there was very low inflation. And in fact, the US economy was experiencing a Japanese-style recovery post-QE, in as much as demand just could not generate inflation. It was a disappointment for the market, and the problem is you're a heavily indebted economy. So now we fast forward to post-COVID QE, and obviously there's supply side shock inflation, and that's where we see real financial repression. So in the chart, when we see the big lurch down to the nadir at the end of 2021, early 2022, this really shows financial repression at its greatest, the Fed policy error of being too far behind the curve. Now, the rapid move in rates throughout 2022 has clearly reduced the magnitude of financial repression, and we've had a repricing of risk assets, but it still exists, as you can clearly see from the chart. Now, when you look at a standalone number, it means nothing. It doesn't. What I'm not saying is when we get to zero, that's the end of financial repression. My personal view, I think you need real rates at between 1.5% - 2.5% before you genuinely could say the TINA trade has unwound. Now, how do I use this data? So whenever I'm positioning my portfolio, I'm always considering the push-pull in the market and how I use this data to perhaps manage the net bias of the book. Now, my base case is actually bearish, and this is well documented in the Society Discord channel. What do we mean by the push-pull? So when we think of the pull being a bearish view, we can look at macro deterioration, geopolitical deterioration, can argue that the consumer's not at maximum pain yet. Credit conditions will continue to tighten even when the Fed pauses due to the lagging effective interest rates and the mini banking crisis that will probably lead to credit restriction regardless of where the yield curve goes. You can argue that EPS has been tracking lower for 3 quarters. Full year EPS estimates are simply too high, pricing in a really material recovery in H2. You can argue the equity risk premium is too low, and I could go on. So all of these are sensible and potentially valid reasons as to why you may be set up with a base case bearish view. The push, on the other hand, is that there is still excess liquidity in the system. The US economy still has $6 trillion more in circulation than it did pre-pandemic. When I think of US pension funds, their assets under management, AUM, it's about 25 trillion. Now, in a bull market, these funds may have a cash balance of 3%, and in a very bearish positioning, that might go up to 7%. So that's quite an active position. This is when they're expecting a sell-off in the market owing to the recession, the inevitable recession, and then they will deploy that cash and they will generate their outperformance. Now, I think we're at the high end of the range for cash balances, okay? And this is because the majority of people are expecting a recession now. If that cash position moves from the high end around 7 back to the low end in a bull market, technical bull market at 3%, that's about $1 trillion of investable dollars that might be looking for deployment. And this excludes all the hedge funds, the herd retail investors who aggregate to a powerful force, and these traders, this retail army. A lot of them are consuming the same blogs, tip sheets, mainstream financial media. So in my mind, I'm thinking, what's going to be the trigger that could deploy a lot of this cash sitting on the sidelines? And I'll have a look at the S&P level of 4302. That's only about 4% higher than where we're trading today. So today is Friday the 28th of April, pre-market. So if we have just a simple look at the S&P chart, you can see we're about 16% above the October lows, another 4%, and we're in a technical bull market. Now, at the technical beginning of a bull market, I would expect the underweights to capitulate and the pain trade melt up to get underway. It'll just be increasingly difficult for excess cash balances to be on the sidelines as we enter a bull market. Can you imagine the mainstream financial media, all the momentum guys, all the technical guys, everyone's pouring into the market? And incidentally, one of the reasons why I think the market has stubbornly refused to sell off really over the last 6 months in the face of deteriorating earnings, deteriorating data, is simply down to liquidity and financial repression. You've got to remember the long funds are net buyers, not net sellers. Now, regardless of your current positioning, my simple point today is that there is potentially $1 trillion of money that could come into the market, and I think the trigger will be only 4% higher from where the S&P is trading today. And that is the trigger to act. Whether you're covering a net short or going overweight, it really doesn't matter. I think trading's about knowing what you're going to do, when you're going to do it, and why you're going to do it. So financial repression and liquidity may be the driving force for a breakout and a pain trade up. Now that may not be my base case, but it's certainly not a zero probability either. So it's about understanding the risk to your portfolio and to be ready and prepared to manage the bias. Financial repression, it's still all around us. So thank you very much, and I will see you in a month's time on an ITPM Flash.